Ever wondered how to approach stock market analysis and picks? Well, you're not alone. The stock market can be a complex and intimidating space, but with the right tools and knowledge, you can navigate it with confidence. The importance of stock market analysis and picks cannot be overstated. They are the building blocks of successful investing. To start, you need to understand your investment goals. Are you looking for long-term wealth accumulation or short-term gains? Next, assess your risk tolerance. How much risk are you willing to take on? Then, you dive into research and analysis. This involves evaluating a company's financial health, growth potential, and competitive positioning. And of course, diversification is key. Spreading your investments across different sectors can help mitigate risk. Staying informed, maintaining a long-term perspective, managing risk, keeping an eye on economic indicators, and considering dividend stocks are also part of the equation. In the next few minutes, we'll break down these steps, making them easy for anyone to understand. The first step in stock market analysis is understanding your investment goals. What do you want to achieve financially? Maybe you're looking towards long-term wealth accumulation. Perhaps it's a comfortable nest egg for retirement. Or you might be eyeing short-term gains. Each goal requires a different investment strategy and approach. For instance, if you're aiming for long-term wealth, you might lean towards growth stocks that have the potential to increase in value over time. If retirement is your goal, maybe you'll be more inclined towards blue-chip stocks that offer stability and possibly dividends. If short-term gains are your focus, you'd likely be looking at stocks with high volatility that can offer quick returns, although this comes with its own set of risks. Your goals will guide your investment decisions and help you determine which stocks align with your financial objectives. By defining your goals, you can make more informed decisions about which stocks to pick. Next, you need to assess your risk tolerance. So, what exactly is risk tolerance? It's the degree of variability in investment returns that an investor is willing to withstand. In simpler terms, it's about how much potential loss you can stomach. Risk tolerance varies from person to person. For some, the thought of losing even a penny might keep them up at night, while others may be comfortable riding the highs and lows of the stock market. Factors like your financial situation, age, and investment goals all play into determining your risk tolerance. For instance, a younger investor with a stable income and distant retirement might be more willing to take on riskier investments for potentially higher returns. On the other hand, someone nearing retirement might prefer more conservative investments to preserve their capital. Understanding your risk tolerance is crucial. It guides your investment decisions and helps you choose the right stocks. Knowing your risk tolerance is essential in choosing the right stocks for your portfolio. Once you know your goals and risk tolerance, you can start your research and analysis. This is a critical step in the process of stock picking, and it involves two main types of analysis: fundamental and technical. Fundamental analysis is about evaluating a company's financial health. You'll want to look at earnings reports, balance sheets, and cash flow statements to understand how the company is performing. You'll also want to assess the company's growth potential. This involves looking at factors like the company's competitive positioning, the overall health of the industry it's in, and the broader economic environment. But fundamental analysis is only half the story. Technical analysis is also crucial. This involves studying stock price charts and identifying trends and patterns. It's like trying to predict the weather by looking at the clouds. You're looking for signals that indicate where the stock price might be headed. For instance, a sudden surge in trading volume could suggest that a significant price movement is on the horizon. However, it's important to remember that technical analysis is not a crystal ball. It's a tool that can help you make more informed decisions, but it can't predict the future with certainty. In addition to conducting your own analysis, it's also important to stay informed about the broader economic environment and industry trends. These factors can have a significant impact on your chosen stocks. For instance, a change in government policy could affect a particular sector, or a shift in consumer behavior could impact a specific company. By conducting thorough research and analysis, you can pick stocks that align with your investment goals and risk tolerance. But remember, investing is not an exact science. There are always uncertainties and risks involved. So, even with the most thorough research and careful analysis, there's no guarantee of success. The key is to make informed decisions, manage your risks, and stay disciplined in your approach. After picking your stocks, the next steps are diversification and staying informed. Diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. The rationale behind this technique is that a portfolio constructed of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. It's like the old saying, "Don't put all your eggs in one basket." In the context of investing, diversification aims to smooth out unsystematic risk events in a portfolio. So the positive performance of some investments neutralizes the negative performance of others. The benefits of diversification hold only if the securities in the portfolio are not perfectly correlated. That is, they respond differently, often in opposing ways, to market influences. However, diversification is not just about spreading your investments across different sectors. It also involves diversifying across different types of investments: equities, fixed income, commodities, and cash equivalents, and across different geographic regions. This can help to further reduce risk and potentially enhance returns. Now let's move on to the importance of staying informed. The stock market is dynamic and ever-changing. News events, earnings reports, and changes in the broader economic environment can all impact the performance of your investments. Therefore, it's crucial to stay updated with market news and any other information that could affect the companies in your portfolio. Keeping your finger on the pulse of the market also allows you to spot new investment opportunities and make timely adjustments to your portfolio. For example, if a company you've invested in announces disappointing earnings, you might decide to sell some of your shares. Conversely, if another company in your portfolio releases a new product that's expected to drive significant growth, you might choose to increase your investment in that company. By staying informed, you're not just reacting to market changes, you're anticipating them. This can give you a significant edge in maximizing your returns and minimizing your risk. By diversifying your portfolio and staying informed, you can manage risk and make timely adjustments to your investments. Another important aspect of stock market analysis is adopting a long-term perspective and managing risk. While the allure of quick profits can be tempting, a long-term approach can help you navigate market volatility and benefit from the power of compounding. It's about patience, perseverance, and a clear vision for your financial future. Risk management, on the other hand, is about safeguarding that future. It involves strategies like setting stop-loss orders to limit potential losses, or using position sizing to control the amount of capital you put into each investment. It's like a safety net, helping you stay on track even when the market takes an unexpected turn. And don't forget, the most successful investors are those who remain disciplined, avoiding impulsive decisions based on short-term market fluctuations. They stick to their strategies, stay informed, and adjust their plans as needed. Remember, investing is not about quick wins, but about growing your wealth over time. Finally, keep an eye on economic indicators and consider dividend stocks. As we delve deeper into the world of investing, understanding economic indicators is key. These indicators, such as GDP growth, interest rates, and inflation, can significantly influence market trends. For instance, a rise in interest rates can often lead to a fall in stock prices, while positive GDP growth might signal a healthy economy, potentially boosting stock performance. Now let's switch gears and talk about dividend stocks. These are shares in companies that return a portion of their profits to shareholders, typically on a regular basis. Dividend stocks can be a great addition to your portfolio for a couple of reasons. Firstly, they provide a steady income stream, which can be especially beneficial in times of market volatility. Secondly, they can offer some protection during market downturns, as companies with a strong track record of paying dividends are often more stable. By considering these factors, you can make more informed investment decisions. So that's a basic guide to stock market analysis and picks. We've touched on understanding your investment goals, gauging your risk tolerance, and the importance of thorough research and analysis. Diversification was highlighted as a key strategy to spread risk, and the necessity of staying informed about your chosen stocks and the broader economic environment was emphasized. We discussed the merits of a long-term perspective and risk management techniques like setting stop-loss orders and position sizing. We also touched on the relevance of economic indicators and the potential benefits of dividend stocks. But above all, the need for emotional discipline in investing was underscored. It's easy to get swayed by short-term market fluctuations, but disciplined investing often pays off in the long run. Remember, investing always involves risks, so it's vital to do your research and consult with a financial advisor before making any investment decisions.